What's up, everybody? Just last week, Opendoor announced it would lay off another 560 staffers, or 22% of its remaining workforce. The company's stock, which was once valued over $34 a share, closed last Wednesday at $1.56. This is a direct result of the sharp housing correction a lot of markets are experiencing all across our country, especially out west. But how did things go so dreadfully wrong for Opendoor? And how could Zillow possibly have prevented their demise? Let's take a look at this article in Fortune by Lance Lambert to see how Opendoor's annihilation could have been prevented. Let's dive right in. In order to best understand what happened, let's rewind to spring of 2021. At that time, the housing market was in full boom mode. Opendoor was just one of the iBuying companies that were doing really well. You also had Redfin Now, OfferPad, and Zillow, to name a few. They would buy homes, do a quick fix, and then resell them for a profit. Or at least that was the plan. Opendoor, in particular, went from a startup in 2014 to number 425 of the Fortune 500 in 2022. It worked like this. Through its online platform, Opendoor makes speedy offers to clients who are often selling homes in need of some tender, loving care in exchange for a service fee. The company then makes the needed repairs, flips the home back onto the market, trying to make a quick buck. Well, fast forward to the fall of 2021. The housing market was still doing well, but there were already mumblings from the Fed Reserve that they were about to start raising interest rates, which would then affect mortgage rates. At the same time, Zillow admitted they had overextended their iBuying program. They had too many houses and not enough boots on the ground to fix their homes and resell them. So in October of 2021, they decided to pause their home flipping business. But just weeks later, Zillow decided to shut it down completely and laid off 2,000 of its workers and then started scrambling to try to sell off its inventory. It turns out that Zillow's algorithm was having issues predicting future price appreciation, which led to overpaying for properties in certain cities, leaving the company dangerously exposed to a housing market correction. As Zillow exited its home flipping program, Opendoor did not seem too worried. On November 2nd, 2021, the same day that Zillow announced it would permanently exit iBuying, Opendoor's shares closed at $21.12. So in hindsight, maybe Opendoor's investors should have paid more attention to Zillow. In late November of 2021, Fed Chair Jerome Powell announced he was ready to combat inflation by raising interest rates. Everybody knew that the goal was to calm the housing market down, and by raising interest rates, well, this is the fastest way to do it. Lambert writes, nevertheless, iBuyers like Opendoor and Redfin Now kept buying homes in late 2021, and home buyers kept bidding up home prices. The music kept playing, but it was about to stop. Cut to the first quarter of 2022, and the housing market goes insane. I've never seen anything like it. I had one listing that got 16 offers and went $400,000 over the asking price, and it was only listed at $899. In fact, U.S. home prices, as measured by the Case-Shiller National Home Price Index in March of 2022, notched a record year-over-year jump of 20.8%. And then the music stopped. Each time the Fed raised basis points and mortgage rates went up. They started at 3.11% in January of 2022 and went as high as 4.67% by the end of March. Gosh, wouldn't it be nice to have those interest rates now, today? Housing prices started to stutter in some markets, but it wasn't really until June of 2022, when interest rates crossed over the 6%, that housing markets really started to correct. Meanwhile, Opendoor kept buying homes. Markets that boomed the most started correcting the fastest, like Boise, Phoenix, and Reno, all of which had big iBuyer presence from companies like Redfin and Opendoor. So what did they do? They started slashing their home prices. When the shiitake mushrooms hit the fan, you, investors, want to get out first. The way to do that is to figure out where the lowest sale is and be 2% 10% below that. And if it doesn't sell in the first weekend, move it down again. Redfin CEO Glenn Kelman told Fortune last fall. In November, Redfin joined Zillow in shutting down its iBuying business. They ended up laying off 13% of its staff. To prosper in a housing downturn that could last at least through 2023, we have to simplify our business, a Redfin spokesperson said. Then in December, Opendoor co-founder Eric Wu announced he would step down as CEO, and Carey Wheeler, the company's CFO, took over. Let's take a look at their financials as reported in this article. Opendoor's revenue grew 94% to $15.6 billion in 2022, as did its losses, going from $662 million in 2021 to a $1.4 billion loss in 2022. Even more glaring is its adjusted net loss climbed 394% from a $116 million loss in 2021 to a $574 million loss in 2022. In total, Opendoor sold 39,183 homes in 2022, up from 21,725 homes in 2021 and 9,913 homes in 2020. Of course, ramping up just as the housing market is peaking proved costly. The Fed Reserve continued to hike up rates at an alarming speed, and Opendoor simply couldn't keep up. We constantly track macroeconomic and housing conditions and adjust our strategies accordingly, but we did not predict the speed of decline in home price appreciation and transaction volumes, wrote Opendoor in a shareholder letter published in February. So now they're chasing the market, trying to offload their inventory before prices go down even more. Back in April of 2022, Opendoor bought a house in Las Vegas for $420,900, fixed it up, then put it back on the market for $480,000 in May. It finally sold in January of 2023 for $346,000. According to a Goldman Sachs report in February, Opendoor expects to sell 85% of the homes they bought at the peak of the market last year by the end of the first quarter of this year. In that same report, Goldman Sachs reiterated its sell rating on Opendoor and reduced its 12-month share price target to just $1. But not everybody is so bearish about Opendoor. Jay McKenlis, a senior vice president of equity research at Wedbush, told Fortune that he thinks that the U.S. housing market is now through the worst of it and that sharp housing price declines are over. The lack of inventory and strong demographics puts a floor on how far home prices can fall. The housing market has already started to bounce back in some markets. Even in the most corrected housing markets out west, price cuts have started to calm down. The improved housing market in 2023, coupled with Opendoor's strong cash position, is why McKenlis has a $3 share price target on Opendoor. That said, that figure pales in comparison to the $34 share price Opendoor had back in its peak in 2021. So what's next for Opendoor? Well, I think the bigger question is, what's next for the housing markets? Will it continue to correct, or are we already in recovery rebound mode? Honestly, I think it depends on where you live. Where I am here in the DC area, the housing market is hot again. Every good house that comes on the market is selling in multiple offers with bidding wars and going way over asking. There's simply not enough inventory. Comment below, let us know where you live and what's happening in the housing market where you are. Opendoor isn't the only company with recent layoffs. GeekWire reported that Redfin also recently laid off 201 of its employees, which is roughly 4% of its workforce. The third round of layoffs in less than a year. If you want to know more about it, check out this next video. Thanks for watching. I do appreciate it. Bye!